Good afternoon, everyone, and welcome to Talk Sense. Today I have a very special guest. I have the CEO of GPI with me. He's got an expertise in asset management, private wealth, silent investments, direct business ventures, and liquid alternatives. So he also talks about listed financial assets, but today we're going to specially talk about capital raising. Please help me welcome Ahmed Refaie.
How are you, Bram?
Doing wonderful. Welcome to the Talk Sense show.
It's nice and a pleasure to be with you here today. Sorry, I've been awake since yesterday, so a little bit losing on the times, but it's a pleasure to be here with you today and speaking about capital raising for all your lovely and respectful audience.
Fantastic. So, Ahmed, one of the things which is happening around the world that people are looking more into digitizing basically our world as it is. And a capital raise is basically a relationship-based kind of interactions we have. So, you yourself have expertise basically doing capital raises in the Middle East, in Europe, in the UK, in the US, and in Latin America. Is there any different way of doing business or capital raising in these different kind of places, basically, or continents?
Of course, every place has its own blend or its own taste and appetite when it comes to investors or people who would like to invest or tap those assets. And you've just mentioned digitizing the assets. So when we speak about digital assets, it goes more of a topic that not every investor, not every ultra high net worth individual can easily understand. Even guys who comes from the traditional background of investment banking or commercial banking and stuff, they are not so educated or aware of the topics. They are not required to be techies or to understand all the technology about cryptography and distributed ledgers and all these fancy names, but at least they need to know where is the value perceived. Because when it comes to digital assets, you can treat them as derivatives, financial derivatives.
Mm-hmm.
Let's say when we deal in derivatives, when we deal in CFDs, like the contracts for differences, you can consider them the same thing. Though they have a security type involved, because when you digitize something and you sell it in terms of the tokens or the coins or stuff, you are promising the investor a series of future cash flows.
Mm-hmm.
So here, from a financial and legal perspective, we can consider it a security because you are promising a cash flow from the future.
Yes.
Though it's been more traded like derivatives or CFDs. Because most of the time you don't have a tangible or physical asset linked or involved.
So if we look at the Middle East, right? Mm-hmm. So in Middle East we have a lot of family offices basically out of here. We have high net worth individuals who are basically based out of here. Then we have sovereign wealth funds,
yes.
And we have co-investments happening. Could you let me know that, what are these co-investments which are basically happening specifically in the Middle East region?
Specifically in the Middle East. So let's start with a global perspective or a global helicopter view. When it comes to the different jurisdictions, the most prominent places are the US. We can, in terms of my personal experience to some extent, is the most thought after place or region where investors are now starting to really, in a precise and practical way, to look into the crypto sphere or the blockchain technology or the digitization of assets.
Okay.
Because it gives more mobility, it cuts the hassle, the long processes and stuff, but it has to be on a solid base. Mm-hmm. And it has to be built on mutual trust and credibility. Mm-hmm. So this is where it comes to US, as well as escaping a lot of the regulations and the tight stuff about taxing and all these things in the US. We are all aware of that, and most of the people are trying to escape as much as they can.
Yeah, so that's also one of the reasons why we see neutral jurisdictions basically come in to play a big role in having double tax avoidance, basically.
Exactly. We have been seeing like tremendous and massive assets and funneling from Europe, from family offices into the Middle East. There is a tsunami of cash coming here, but the problem, they can't find the right places to invest. They can't source or determine the right VCs or the right startups or the right projects to invest in. Everybody's searching for the unicorns, but no one knows which one is the unicorn.
That's
so
true.
this is a problem even for professional funds and seasoned investment vehicles. They don't have this right now. They're so absurd.
So could you give me an example of co-investing?
Okay, when it comes to co-investing, like I said, US is the most active one right now, or trying to be active. China or Asia, they are very sophisticated investors, but the problem there is just they are, degrading each other's until everybody dries out.
Got it.
So this is the problem with Asia,
Yeah.
but they are way, way better than Europe. Europe right now is a little bit less favored when it comes to capital raising and investments and stuff, because of the regulation and stuff and all those things going.
Is it only the regulations, or is it also the interest rates, which are, like in
Of course, the interest rates.
Denmark is like negative.
It's a debatable issue or a debatable thing to talk about right now. Maybe we can have a banking discussion more related to the negative interest rates. But like from past experiences, Japan and Europe have tried this once or twice before and it didn't work.
Yes.
And they're trying it again. The same way with US, they have tried quantitative easing before and now they are about to start doing it again. And I don't know what those guys see exactly, but maybe the things have changed.
So right now, what you're seeing in the market is basically capital fleeing from Europe and coming into the Middle East. Am I correct?
Yes, and fleeing from Latin America into the US.
Okay. And this is basically seen as a safe haven or kind of transaction, or is this more out of seeing better returns on investments?
Actually, the major concern for the Europeans coming to the Middle East or Asia is for preservation of capital. This is the highest priority.
Okay.
For the Latin going to America, they are seeking safe jurisdictions where they can have solid and holding structures for their funds and their capitals and their wealth and for the next generations.
Okay.
So it's a little bit of a tricky part when it comes to intergenerational wealth transfer.
So the capital raise within the Middle East. Now, I just mentioned before, basically, we see family offices being a lot out of here. Could you tell us a little bit about how the process works in this capital raise?
When it comes to capital raise, the first thing, you are a consultant, first of all. So you need to study well the requirements of the venture or the investment you are trying to raise for. So you need to understand it well. You're not supposed to be an expert and go and dive deep into details and stuff, but at least you can have like a general high-level view which grasps the key characteristics and components of the investment you're trying to raise for, whether it's your own project or your own investment, or you are raising for a client or raising for a fund or something like that. So from the other side, you have to learn about the investor's needs. You have to provide them with some kind of a synergy or advantage or a perceived value out from this investment. So you need to have a team in place, consider it like a business unit or a department, whether it's like in the formal corporate structure or in the casual style, whichever the model is. And you need to have a plan in place. So everything to be planned and structured. And you need to have a procedure. When it comes to procedure, it's more of a sales procedure. So as a capital raiser or someone who raises capital, you are actually a consultant and a sales person.
Correct.
And the best salespersons in the world, you'll find them to be the CEOs. Any successful CEO must be a very good salesperson.
So could you tell us some of the triggers, basically, which makes somebody invest into a proposition where you as an advisor, as a consultant, come in to give?
Okay, let me tell you something which is a little bit critical here, which is you need to have something in place to show, like a business plan or at least an executive summary.
Okay.
Most of the startups or the entrepreneurs, they don't believe in the old school models anymore, and they believe that they don't work. We can agree with them to some extent because maybe it's not based or formulated on a solid basis, but you need to have it in hand, though it would just like fill 30% of what you're doing. It's not the entire thing. All the materials you have, business plans, pitch decks, investor presentations, marketing materials, all those are supplementary, are complementary. It's all about the storytelling, how you tell it, and how you deliver your story to the investor, and you need to just demonstrate 5 things.
Okay.
So here is the answer to your question.
Got it.
Which is the first, you need to address a stake or an urgency that you are addressing from your investment or your venture. Second thing is to show a positive impact out from this investment or out from your solution you're trying to produce or to offer, whether it's a service or a good or whatever the investment is. So I'm not here talking particularly about blockchain, I'm talking on the wider space of capital raising for whatever, manufacturing, industrial, service, IT,
of course,
whichever it is. So you need to address a positive impact and to give examples of past experiences of other companies that went viral, others who just died. So you need to address this thing with where the adhering to what you're doing or the change you're trying to chase is going to result in winners and losers.
Got it.
So this is the second thing. The third thing is how your solution or how your investment is solving a problem or relieving a pain for the market you are addressing.
Got it.
This is one of the most important one. You need to have a differentiator. What differentiates you from the others, from the peers? And you need to put in place the scenarios of the competitors, how they're going to react for you entering the market or entering the sector or the industry. So you need to have this analysis with you. And to finalize this third point is how you're going to deliver this to your clients or to your targeted customers is tough, like how you're going to customize the experience for them or adhere to fulfilling their requirements.
Okay, very well put. What are the fourth and fifth?
The fourth one is the features and the options of your product or service. Or the investment, like maybe the investment is just providing a preservation of capital. Maybe the investment for the investor side is just providing well-promised potential returns. Maybe it's providing hedging against inflation, interest rates, uncertainty, risks. Maybe it's providing intergenerational wealth transfer in a sufficient way, which is more of the offshore banking style and the private wealth things that we are doing in all these things. And in terms for the VCs, they need to show the feature of their problems and how it delivers what it promises to deliver. And you need to demonstrate how life will look like with your service or product.
Got it.
And how what obstacles are you overcoming here? What pain are you relieving for the end receiver of the investment? And the last one is your team. And this is the most critical one. As we always say, the jockey is much more important than the horse. So
yes,
you need to have a good jockey. So the team, you need to demonstrate the teams, their buyers, their timelines, their past experiences, how they are able to deliver what they are promising to deliver.
So within TalkSense, we talk often about digital securities. And when we speak to potential investors, basically, we also try to give them that picture which you just told us, what how world will look like, basically, looking at presently as it is right now. So going from a paper-based share into a digitized shareholding on a blockchain is basically something which we can definitely look at. But then again, you started off with team behind it, because people need to have a track record to be able to show that the proposition which you're giving is really going to change as we do day-to-day business. So now looking at what is going on, it remains a bit the urgency, because that's number one point you pointed out, and I feel that urgency at times can be missing when delivering your talk for an investor to be part of a new venture, basically. So how do you see within the digital securities market, basically, the urgency to get more investors on board to look into this new technology and utilize it, where we will have results like disintermediation. So the intermediaries within the traditional way we do business will be eliminated, or at least some phases will be taken out.
Yes. So to compromise on your point, like when you are talking about digital assets or tokenization of assets and all this overhyped stuff or issues, that's what sometimes people misuse or abuse the term.
Sure.
So always, it's nothing new. It's just like coined or termed in a new way and in an exciting, appealing, interesting way. People are used to digital transactions. Like we are already using our credit cards, online payments, transfers, and all that stuff. Absolutely. So already it's nothing new from the concept. We are all used to all these paperless transactions, and the world is heading towards paperless societies and stuff. So it's easy to integrate it. The problem here is just like the created bubble around it that makes people skeptical about it, or a little bit hesitating or itchy when it comes to those fancy terms, which in reality, the underlying concepts are so simple. The concepts have been here 20 years ago. It's nothing new. We just had the technology or the ability and the power to implement it. That's it.
Got it.
So when it comes to the blockchain or the tokenized assets and digital assets and stuff, in order to be successful in delivering those to the investors and get them to be hooked on those deals, you need to make it in a simple way. All the guys are talking about, all the ventures are talking about blockchain, digitization and stuff. They bring a lot of terms and every day you hear a new thing. We went from ICOs to STOs to IEOs, and now I've been hearing like IDOs and IWOs and I keep laughing when I hear this, because like it's really, there is an asset or a no asset.
Got it.
A physical tangible one or an intangible one. Anything that has a market value, as we know, is an asset.
Got it.
Anything that can be exchanged is an asset. But for a successful project or investment, you need to have like a team behind it, and you need to have like, look for example at any project, when it have a large number of developers working on it, we give more weight to this.
So what you're basically saying is that you have to look at the following or the community behind it.
Exactly. You need to have a community.
To have a good, successful project.
Of course, and you need to have an outstanding demand as well, or to create the outstanding demand, or to have the prospectus of this demand.
Got it.
When you are addressing a very good or efficient economical model, that's why we call it tokenomics.
Got it.
So it's all based about the token economy that used to be designed by gamers and game developers and casinos, and
Got it.
It's the same concept, but you just address it in an economical way in terms of the domestic or the aggregated macro economical style or the geopolitical span if you are addressing a global venture.
Got it. So Ahmed, thank you so much for coming in and explaining basically how the process of capital raising has been working for you.
Thank you.
And I hope you got some value out of this podcast of ours. And keep us following on TalkSense, and I hope to see you in the next show. Thank you.
Thank you.